Trump's removal of Maduro in Venezuela unlikely to disturb near-term oil markets. Analysts told CNBC that despite a dramatic U.S. operation that captured President Nicolás Maduro and his wife, the overthrow is not expected to rattle oil markets in the short run. Venezuela, while holding the world's largest proven oil reserves, currently produces under 1 million barrels a day, roughly 1% of global output, and exports about half of that. With the market already oversupplied and demand weak, Brent crude is projected to rise only $1 or $2, if at all, when futures resume trading, and could even dip lower next week. Experts such as Arne Lohman Rasmussen of A/S Global Risk Management and Bob McNally of Rapidan Energy argue that the immediate risk to production is limited, estimating that at most a third of Venezuelan output could be affected. The broader oil sector has already faced a steep 2025 decline, with Brent down about 19% and U.S. crude nearly 20%, as OPEC Plus increased supply and U.S. output hit record levels. However, medium-term outlooks suggest that if sanctions are lifted and foreign capital returns, Venezuelan exports could climb to 3 million barrels per day, potentially boosting the market later. President Trump confirmed the embargo stays in place but hinted that U.S. firms will invest billions to rebuild the sector, though no specifics were given. Companies remain cautious, awaiting clear terms, while ExxonMobil still seeks debt repayment from PDVSA. The prospect of tapping the world's biggest oil reserves remains enticing, but investors weigh it against evolving demand trends, especially as climate policies waver and electric vehicle sales slow, which could revive oil demand and make Venezuelan reserves more attractive.